are the same, like. So I'm recording all this session that just in case someone has missed out on something, when I post it on the group, you can easily review. It does not mean that if I'm recording, you get away from the training, because normally when I put on a recording on Zoom, people tend to abscond. So I'm recording this and I'll share it after for that purpose and for record purposes. So we are going to look at a total education plan. A total education plan is under life assurance, just among the individual products I shared with you last time. So it also, just the way you see other life assurance products, remember I said all life assurance products, the main objective is to maintain wealth and give financial protection, protection. So a total education plan is under the portfolio. But remember, I said some of the products maintain wealth, some give financial protection. Then there are some that combine. When we look at endowment, it combines. When you look at a triple payback from 15 years and above, it combines. A 10-year plan only gives financial protection. Now, the product we are looking at, which is a total education plan, it combines, it maintains wealth for the sake of school fees for a client, and at the same time it gives financial protection for the sake of school fees. The main reason why in a total education plan, we maintain wealth, at the same time we give financial protection, it is all focusing at school fees. It focuses at school fees. So when we say total education plan maintains wealth and gives financial protection, it maintains the wealth so that it keeps a child in school. At the same time, it gives financial protection. It provides finances in the event of death of a parent to keep a child in school. It provides finances in the event of critical illness in order to pay school fees. It provides finances in the event the parent has become permanently disabled to pay school fees for a child. So when we say in a total education plan, we maintain wealth and give financial protection, it is all focused at paying school fees. Hope you've understood that. Now we are going to start on the slides of a total education plan. The way you hear total education plan, it keeps the child in school. We are talking about total education plan, how someone can keep a child in school using a total education plan of ICA group. Why would someone need risk management to keep a child in school? Now those are the things we are going to go into details. Total education plan, some people call it a child educator policy. You know, why would someone need risk management for a total education plan? Why? First of all, total education plan. Total education plan. Okay, that's a total education plan. When you're talking about a total education plan, we are planning for the child's education using insurance, using risk management. The first question normally people get surprised, how does insurance connect with a child going to school? Why is risk management having a play? You know, normally people have those hard questions. How is risk management connected to a child going to school? Why would someone need risk management to keep a child in school? Okay, why do we need a total education plan? Remember we said the objectives of life assurance is to maintain wealth, okuuma obugagga. That is how we call it in Luganda, okuuma obugagga. And we say, how do we maintain wealth? We make sure that a person has money now and money in the future. Another person asks, how do you make sure that the person has money now and money in the future? We make sure the person has money now and money in the future through saving money in an insurance company. Then two, the money they save, we invest it. We invest it. That's how they maintain money. That's how we maintain that, making sure person has money now and money in the future. Now, in this case of a total education plan, we need to keep money. We need to make sure the person has money now and money in the future in order to pay school fees. So when we're talking about a total education plan, the maintaining wealth, the keeping money and the investing money, it's for the sake of keeping a child in school. It's for the sake of educating a child. It's for the sake of a total education. Total means a child. Hope you've understood that. Now, the financial protection. Why would someone need risk management for a child's education? Where is risk management in the event of a child's education? Now, how the first question you have to ask yourself, what keeps the child in school? It's the parent who keeps the child in school. True or false? Yes. But this parent has to have money, has to have income to keep the child in school. Someone is sending me a message. Is it a yesterday that the volume is too low? Is that true? Can you increase, kindly, this could be the same person yesterday. Can you increase volume on your side? Because I tested the volume on my side, it was too high. So go to your gadget, you increase volume, kindly. So we continue. I was talking about financial protection. And I'm saying financial protection, remember we said last time that finances provided in the event of a risk. So some of these risks that happen in people's lives affect their children to continue with school. For example, if a parent dies, that is a financial loss to the child. The child will not keep in school. You have seen orphans, you have seen street kids on the street. Some of them are orphans. They lost their parents. They can't go on with school. You're getting it. If a parent suffers critical illness, a child can't stop going to school because the parent who was paying school fees is in hospital admitted, is not working anymore. So that is why someone would need a total education plan that maintains someone so that even the parent is okay, he has money now and has money in the future to pay for school. But even if he passes away, there is still money to keep the child in school. Even if this parent suffers a critical illness, there is still money to take care of this child's school fees. That even if this parent survives to maturity, the child still has money to take care of their school fees. Even if a parent suffers a permanent total disability, it cannot stop a child to continue with school. So a total education plan maintains the parent's wealth to keep the child in school. At the same time, it provides finances in the event of a risk to keep the child in school. Hope you've understood that. Now here in our slides, they're asking us, why total education plan? Why a total education plan? One, some of the questions you have to ask these parents, or a parent like me, equally I am a parent of 3 children, you know? So if someone asks me, why, Brenda, would you buy a total education plan? If my answer is yes to these 3 questions, then I need a total education plan. 1, do parents know that the future or life is uncertain? Of course we know. We have seen COVID happen. COVID has taken away so many parents. Oh my God. I don't know how best I can explain this. This morning, someone told me about some classmate of mine. She was called Judith, who passed away because of COVID. And Judith has left 5 children. 5 children. The baby is 2 years old. She had a 15-year-old, she had a 13-year-old, she had a 9-year-old, a 7-year-old, and a 2-year-old. And Judith is not anymore. But did Judith see herself dying, you know, in 2021? Did she see herself leaving a 2-year-old baby? Oh my God. All the children she has left are ongoing children. So life is uncertain. So if I'm the parent, if I'm asked that question, Brenda, do you know the future or life is uncertain? Of course, yes, it is uncertain. Death can knock any time. Someone can lose a job anytime, but then children still need to go to school. So if death can't stop a child to go to school, then I need a total education plan. Yes, if life is uncertain, my life being uncertain shouldn't stop my children to go to school. So, Brenda, do you know that the future or life is uncertain? Yes, it is uncertain. If my answer is yes, then I need a total education plan. Number 2, is your child's education dependent on your financial well-being? 99% of us parents, the education of our children is dependent on how well we are financially. Hope you are understanding that. 99% of us parents, 99% of us parents, the education of our children is dependent on how we stand financially. When you find today a parent has a lot of money, they'll take their children to international schools or to the first world schools, the Budo, the, you know, the Kampala parents. When they are not okay financially, you find them looking for the village schools. So the education of our children is dependent on how we are financially. So if that answer is yes to me as a parent, then I need a total education plan, because not all the time I'm going to be financially well to take care of my child's education. In the quality schools I'll need my child to go to. Then number 3, did you know that school fees is ever increasing? If you're asking a parent like me, if you are fellow parents, do you know that school fees is ever increasing? Yes, we're in a lockdown, but school fees is ever increasing. I can give you a simple example. The time I was in Makerere University in 2003, 4, 5, those years, the course I did, the BSTART, was at 500,000 shillings. Some of you are young. Me in 2003, 4, 5, I was at Makerere University. But that time, tuition of BSTART were the pioneers of statistics, the Institute of Statistics. Now I know they are called colleges. That time, tuition was only 500,000. Recently, before the lockdown, I took a cousin of mine to Makerere University to do the same course I did. That's so many years ago, that's 15 years ago. But then the same course BSTART with all the functional fees is 3.5 million. So if that child that I'm joining now university, the time I was at the university, if that child was 4 years old, right? And right now he's joining, if the parent that time was planning on Makerere University at 500,000, and right now he's paying 3.5. It means that school fees has increased by 800%. That is the increment rate. So if today a parent has a 4-year-old child, in 15 years to come when this child is joining university, tuition will not be 3.5 just the way it is right now. It will be like 21 million. So for that parent to afford that future tuition, they need a total education plan now. So if every parent knows that school fees is ever increasing, right? Year in, year out, the answer is they need a total education plan to manage. They need a total education plan to manage. So if the above questions are answered by the parent, yes, then a total education plan, they need it. It's their plan for them. If a parent knows that life is uncertain, they need a total education plan. If this parent knows that education is dependent on their financial well-being, then they need a total education plan. If the parents know that school fees is ever increasing year in, year out, then they need a total education plan. So if the above answers are yes, then a total education plan is the solution. These are the key features of a total education plan. The key features of a total education plan. One of the key features, when I say features, I mean the characteristics, the properties of a total education plan. That when someone talks about a total education plan, you know how it looks like. Now, the first feature of the total education plan, one, it has two phases. It has two phases. The first phase is what we call the premium payment phase. In other products, that's what we call a policy term. When the client is paying money to the insurance company, when the client is saving on a monthly basis. Now that phase in a total education plan, that's what we call a premium payment phase. Then the second phase is what we call the benefit payout phase. The benefit payout phase. Now, this is the phase where the person stops paying premiums to the insurance company. And now the insurance starts paying school fees for this child. That is the end of the policy term. But assuming a client opened up a 10-year plan and the end of the 10 years they have stopped. Now the insurance company starts paying the school fees for the child in a school. School fees, either termly, annually, every after 2 years or annually, it depends on what the client wanted. So that phase is what we call the benefit payout phase. That phase, the person is no longer paying premiums to the insurance company, is no longer putting money in the insurance. It's now the insurance, it's the time for the insurance to start paying school fees. So this cover has two phases. It has the premium payment phase and it also has the benefit payout phase. The benefit payout phase is that phase when the person, when the insurance company starts paying school fees for the child who was assured. Hope you've understood that. Now, the premium paying phase, or what we call the premium payment term, when the client is paying premiums to the insurance company, that is what in other products we call a policy term. That's what we call in other products a policy term, how long the period the client can have a cover. So in this total education plan, the premium paying term is between 5 years to 21 years. 5 years to 21 years. It is in a series of one. What do I mean by that? That someone can have a 5-year plan, a 6-year plan, a 7-year plan, up to 21. Assuming, I want to give a simple example. If I have a baby right now, I can decide to open up a total education plan for a 21-year plan. What am I focusing at? That maybe I'm saving for my child's tuition when he wants to do masters. That's a 21-year plan. So in 21 years, my child will be joining masters. When we get to that point, it's the insurance company to pay. So someone can have a 6-year plan that today, if you have a baby, let me say in 6 years, this baby will be joining P1. That by the time the baby gets to P1, school fees is already available and the insurance company is paying. Hope you've understood that. Now, the benefit payout phase, number 3, the key feature, the benefit payout phase. This is the point, as I told you, that the person has stopped paying premiums to the insurance company. Now the insurance company is paying school fees to the school. Now let me give you a simple example, maybe to illustrate you better. Assuming I have a child who is a baby and I decide to open up a 6-year plan. In 6 years, this baby will be joining P1. So maybe I open up a plan that by the time this baby gets to P1, school fees for P1 to P7 is already available. So when I open up this scheme, every month I pay to the insurance company according to the kind of schools I want. I pay on a monthly basis, maybe assuming I'm paying 200,000. In 6 years, how much will it be? It will be 14.4 million. Now, because it will be 14.4 millions, it will be 14.4 millions in 6 years. Now, because the insurance company has not been sitting with it, it has been investing it. The insurance will not only give me 14.4 millions, it will give me more than 14.4 millions because it was investing my money in those 6 years, right? So what will be my return? My return on the money I have saved for the insurance company for school fees for my child, it will depend on the benefit payout phase. Now, this benefit payout phase is between 3 years to 10 years, meaning I can choose to have a 3-year payout phase, and I can tell the insurance company that this 14.4 million you have saved for me on my behalf, give it to me back in 3 years, or pay it to the schools of my child in 3 years. Or I can say that pay the school fees to the schools of my child in 4 years, or 5 years, or 6 years, or 7 years, up to 10 years. But the beauty about choosing a longer benefit payout phase, if I choose a 10-year benefit payout phase, the insurance company will give me too much profits compared to a person who chose a 3-year payout phase. Hope you understand. If I choose a 3-year payout phase, insurance company will give me small profits. It will give me an investment return which is small. Like it can give me 3%, it can give me 10%. But if I choose a 10-year payout phase, now the example I used, that if my child is a baby and I'm planning for P1 to P7, the classes can guide me on which benefit payout phase I can choose. Now, for example, in that case, I can choose a 7-year payout phase where an insurance company will give me money in P1, P2, P3, P4, P5, P6, P7. Annually, it gives me money once. So that is a 7-year payout phase. So if I tell the insurance company that when my policy matures, when my child gets in P1, I want a 7-year payout phase, they'll give me a bonus rate of 30%. What does that mean? If I have put in 14.4 millions, what would be 30%? At my age, maybe 30% of 14.4. Someone can calculate, or I can calculate for you here very fast so that you can know what would be 30% of 14.4 millions. What will it be? 30% of 14.4 millions, it would be 4.3 million. So it means if I gave them my 14.4, instead of giving me 14.4, they will give me 18.7 millions. It means I have made a lot of profits. Yet someone who chooses a 3-year payout phase, you realize they will just give them 10%, meaning they'll add for them 1.2. But for me, I've been added almost 7 million. It means I'm getting 18.7 millions. That's what I'm getting. I'm getting because I chose a longer benefit payout phase. So the longer the benefit payout phase the client chooses, the higher the profits. The shorter the benefit payout phase, the lower the profits. Hope you've understood that. Monthly premium can be as low as 100,000. But it is always advisable to depend on the need of the client. If a client wants to take a child to an international school, you can't save 100,000 because an international school is a bit more expensive. The 100,000, if I was saving 100,000, let me say for 6 years, that money will not be enough for the international schools. But then he can save that 100,000 for average schools. It would be enough. If I'm taking a child to Buganda Road, it can be enough. So it depends on the kind of schools the client wants to take their children to. So, but what you have to know, monthly minimum premium is 100,000, but based on the need of the client, what kind of schools would the client want to take the child to? If the client wants international schools, of course, the premiums will be more. We'll do an illustration to show you an example of international schools and low-income schools. Then payment frequency. A client can pay monthly, can pay quarterly, half-yearly, or annually. They can pay their premiums monthly, quarterly, half-yearly, or annually. But remember, I said, when we are saying that it has to be prepaid. It doesn't have to be postpaid. Prepaid, what does it mean? The person pays the month before they enter into it. They pay the month before they enter into it. Benefits of this cover. This cover The school fees is payable to the school of your choice on maturity. Now, if the client, let me say the policy has matured, assuming my 6 years I've been paying to an insurance company are done, and my child is joining P1, if I tell ICA pay school fees to Kampala parents, that's where it will send the money. If I tell it send the school fees to Aga Khan, that's where it will send the money. If I tell the insurance company, give me the money, I will take it there myself. They will give it to me. So school fees is payable to the school of your choice, or the client can decide, give me the money and I know where to take the school fees. As simple as that. We will do that. Then number 2, school fees is payable in installments. Just the way you've seen the benefit payout phase. When we collect this money, we don't give it to the client in a lump sum. You know why? The person can divert it. Assuming, I gave you that in simple example, I'm putting maybe 200,000 for 6 years, and the insurance company has given me 18.7 for P1 to P7. If they give me all that money at once, if I'm a business person, I'll be like, let me first put it into my business. Now, what if the business goes into COVID? It means the child would have lacked education. But what the insurance does to assist parents not to risk to misuse that money is not given them at once. Just the way you saw the benefit payout phase. The client can choose a 3-year benefit payout phase, 4-year, 5 years, according to the need, so that they don't misuse that money or misuse it, put it into other things that would affect the child's education. So we give that money in installments to prevent diversion of that money. Then number 3, duration of frequency of fees payment is one's choice. The way I said, a client can choose a 3-year payout phase, can choose a 5-year, a 6-year. It is a client's choice. We don't go into those nitty-gritties. Bulira classes because it's a no. It's a one's choice. Even if a child is to study from senior to senior, those are such a 6-year payout phase. But then we'll tell a client, if he wants 3-year payout phase, it's up to him. We give him that. But remember, when you choose a shorter payout phase, it affects the bonus returns. Then, on death of the child during the payout period, if this child, assuming I was saving for this child's school fees for P1, but God forbid, by the time the child gets to P1, he dies. If a child passes away when the child has just started P1, let me say I've finished paying my premiums to the insurance company and we were supposed to start the installment payments to the school, but God forbid the child dies. What the insurance company will do will not continue paying the installment it had promised. It will get all my money in a lump sum. It gives it to me. Are you getting it? They will not make a parent wait for those installments. They'll give the parent all the lump sum with the accrued bonus at once. Now next, on death of the child during the premium payment. Now the other part was if the child passes away when the policy has matured, we don't make the client pass through the benefit payout phase. We give them all their money in a lump sum. Now, what if the child passes away during the premium payment phase, when I'm still paying premiums to the insurance company? What happens? What we will do, this client can decide to choose another child to replace for that cover. If they don't have a child to replace, then we can give them back their money they had contributed to divert it to either they can open up another endowment cover or use their money whatever they want. As simple as that. Additional benefits. Now we are going into the issues of financial protection, because now we are done with the issue of where the client says we've been investing the money. That when the 10 years are done, or the 5 years or the 6 years, we give back the money with the accrued bonuses because we had invested it. And the accrued bonuses, we say, they depend on the benefit payout phase. Now we are going on the other part of financial protection, the finances provided in the event of a risk. Now these are the additional benefits. A client who is saving school fees in an insurance company, we cover them on the risks: 1, over last expense, and 2, child income benefit. Now, this child income benefit, this is the money that they pay to the child in case their parent has passed away, in case their parent has become permanently, totally disabled. Or a last expense is the money, the last expense. The last expense is the money payable to assist on all expenses incurred when that parent has passed away. For example, to bury that parent. Or number 2, if the child has been left in a certain class when there is some balance of school fees pending. Now, let me explain in detail. When our parent who has insured their child passes away, we will give a sum of 15% of the sum assured within 48 hours. I want to explain this more. God forbid, if I'm the parent who has a total education plan for my little baby Hope, God forbid if I pass away, the insurance company will give 15% to my people to assist me in the burial and any other expenses of the sum assured. Now, I used an example of a 14.4 million sum assured. If I had a cover of 6 years, and God forbid I pass away before the end of, let me assume I've just opened it on, maybe my baby has just joined baby class. She's 3 years and she has joined baby class, and God forbid I die. Immediately, insurance will give my family the 15% of my sum assured. What is 15% of the sum assured? Remember, I said if I'm contributing 200, in my child's total contribution will be my sum assured here. So what would be the total contribution? It would be 14.4. So 14.4 million, what is 15% of the 14.4 million? 15% of the 14.4 million is 15% of the 14.4 million is 2.16. So they'll get 2,160,000. They give it to my family to assist it in my burial. So if you realize the last expense for a total education plan is higher than a triple payback, is higher than an endowment. Why is it high? Because the expenses, a kid may have been maybe in nursery first term and second term has to be paid. They can use some of it to bury me. At the same time, the balance can be used to take care of that pending school fees. Hope you've understood that. Now, the child income benefit, it's what takes care of education, that in case this parent passes away, if the life assured, the parent passes away before the end of the policy term, as the example I've given you, assuming I have a 6-year plan, but God forbid I pass away in 3 years, before the end of the 6 years, before my child gets to P1, the class I was planning for, what the insurance will give my child is what they call a child income benefit, to keep this child in school until the child gets to P1. So every year they'll give my child 15% of my sum assured. That was 2,160,000. They give it to my child in baby class. They give that money again to my child in middle class. Insurance again gives my child in top class. Even when my child gets to P1, insurance pays for my child's school fees from P1 to P7, just the way we had agreed. If I had insured my child for the whole university, it means the insurance will keep my child in school until university. So being alive or dead, my child has to keep in school by use of a child income benefit and the full school fees benefit. Either I have paid that money or I have not paid it, as long as I'm insured. Hope you've understood. So it's the child income benefit that keeps the child in school. That is the child income benefit that pays school fees on a term until the child gets to that class I had insured. Even when the child gets to those classes I had insured, insurance has to pay money to keep the child in school. Either I paid all that premium or I have not paid it, the child will keep in school. So why wouldn't someone buy a total education plan? Then the last additional benefit is what we call a waiver of premium. If I pass away, God forbid, insurance does not expect from anyone any premiums. We waive away premiums. If I was paying 200,000 and God forbid I passed away in 3 years, how will these other 3 years be paid so that they can pay school fees for my child from P1 to P7? Insurance will forgive me when I die. It will forgive. That's what they call waiver of premium, waiver of premium, waiver of premium. Insurance will not charge my family any more premiums. They will not expect any money from my family again. They will not, but my child will keep in school. The insurance company will keep paying my child school fees, the child income benefit and the full school fees benefit at maturity. Hope you've understood that. So that is what we call a total education plan. I want to share with you a simple code for a total education plan so that you understand it. Disclaimers, terms and conditions, just the way you saw endowment last time. Also, this total education plan lapses before the policy makes 3 years because of non-premium payments. So if someone goes into arrears of 3 months, the policy will lapse if they have not made 3 years. So our client has to keep their policy up to date so that they are always on cover, so that their children's education is always covered. Either they are permanently disabled or either they have passed away. Their cover has to be active. They have to pay their premiums. So in case they go into arrears before the policy makes 3 years, they'll be off cover. That is the only. In a total education plan, we do not have a loan provision. We don't have a loan provision. So no borrowing in a total education plan. Just the way you send out their policy loans in a total education plan, there is no borrowing. You know why we don't lend money in a total education plan? What if someone borrows on this money and they fail to bring it back? It means we will not have made the child's education certain. We will not have ensured the child's education. So we don't want people to play with children's school fees. We do not accept loans on a total education plan. So on that note, let me go and I share with you one of the simple quotes on a total education plan so that you can understand what I'm talking about very well. I'm going to give you a simple quote so that you can, for illustrations, I'm not going to go into calculations, but I'm going to put to direct you how you do, because the calculations of a total education plan, they are very simple. They are not hard, they are direct. They are direct, they are simple. Okay, now let me show you a simple example here. Let me share the screen. A simple example for a quote of a total education plan. Now I want us to use this a simple example of this client. Hope you're seeing that simple client. That's, oh God, sorry. Okay, it's there. Now look at that simple client. That client every month contributes 100,000 on a monthly basis. For a period of 10 years, assuming he has a baby of 3 years, this client is 30 years. This client is 30 years and opens up a 10-year plan. And maybe what is he focusing at? He's focusing at that in 10 years, maybe the child will be in senior 1. So this money maybe can assist him to start, for a child to study senior 1 to senior 6 or senior 1 to university. So on a monthly basis, he puts in his 100,000. 100,000. In 10 years, he would have contributed 12 millions. He would have contributed 12 millions, but will give him a school fees benefit of 14.9 millions. You know what that means? He has picked a payout phase of a 6-year payout phase. He's saying that I want you to pay money for my child from senior 1 to senior 6. But because he has chosen a 6-year payout phase, his school fees benefit will be 14.9. It means we have added him an extra 2.9 millions. That by the time the child gets to senior 1, we will not only give this parent 12 million he collected, we'll give him 14.9, almost 15 million to assist the child study from senior 1 to senior 6. Now, what if this parent passes away? Assuming this parent has decided a cover and it passes away when the child is in P1 and the child has not yet reached to senior 1. Remember, by the time the kid gets to P1, this parent would have given us money for only 3 years, roughly. Now, that is where the child income benefit comes in. That is where the child income benefit comes in. So it means annually, after 1 year of this person's death, in P2, insurance will give the child 2.2. What does that mean? That every time we are roughly giving this child 680,000 to keep the child in school. So the child will study P1 with a 2.2. Then P3 with a 2.2. P4 up to P7 will be giving this child 2.2 to keep the child in school. Now, when the child gets to senior 1, then we release the 14.9. That will help the child study from senior 1 to senior 6. But ask yourself a question. Did the person give us that money? No, because they have a life cover. They are protected. They are financially protected. We said a total education plan keeps the child in school. Either the parent is alive or dead. As simple as that. So, hope you've understood. The calculations are straight. If someone tells, I want to again use Sheila Namagembe. If Sheila tells us, as a simple example, Sheila tells us, you know, Brenda, I have a 3-year-old baby. I want to plan for this baby to go to maybe to go to Namagunga. Maybe the baby is 3-year-old. So how many years do we have for this baby to go to Namagunga? We have roughly 10 years. So Sheila Namagembe can open up a 10-year plan. So we plan for how much. The first question we ask ourselves, how much does Sheila's baby need to go to Namagunga in 10 years? Remember, we said school fees is ever increasing. Don't think Sheila Namagembe that the school fees they are paying right now in Namagunga, it will be the same school fees they will be paying in 10 years. So you first ask yourself, how much school fees are they paying right now in Namagunga? If they are paying, assuming 2 million, in 10 years time, how much will they be paying in Namagunga? That is the question. So how do you get to know how much they'll be paying in 10 years time? Just know every school increases school fees by 50% every 5 years. Every school increases school fees by 50% every 5 years. So if they're paying 2 million, what is the percentage? What is 50% of 2 million? It is an extra million. So it means in 5 years time from now, it would have increased by an extra 1 million. So it will be 3 million. So again, if we do another extra 5 years to make it 10 years, so 3 million, what is an extra 50%? It will be 4.5. So by the time Sheila Namagembe's daughter or son gets to Namagunga in 10 years, it will be 4.5 million. So if Sheila Namagembe wants the child to study at Namagunga in 10 years to come, it means every time it will be 4.5 million. So if we multiply 4.5 million times 3 times in a year, how much is it? 4.5 million times 3 times, it is 13.5 times 6 years when the child is in Namagunga. It will be, so Sheila Namagembe in 10 years to educate a child in Namagunga in 10 years time to come from senior 1 to senior 6, she will need 81 million. So what we have to do in an insurance company to show Sheila how she can collect 81 million in 10 years. So we'll just say 81 million divide by 12 months in a year, divide by 10 years. It means every month, Sheila Namagembe will be contributing to the insurance company 675,000 on a monthly basis so that she can afford the Namagunga. Are we getting it? By the time the child gets to Namagunga, the insurance company would have collected on behalf of Sheila 81 81 millions. But because we have been investing this 81 millions, we will not only give her 81 millions. If she chooses a 6-year payout phase, we'll just say 28% times 81 millions. We'll give her an extra 22.6 millions. It means Sheila Namagembe will be qualifying for 103 million. She collected 81 million, but because we have been investing the money, we'll give her 103 millions. So when we give her 103 million, we are going to give it to her in 6 years. We are going to get this 103 millions. We are going to get this 103 millions. We are going to get this 103 millions. We divide it by 6 years. So it means annually, Sheila Namagembe, when the child is in senior 1, we give her 17.2. When the child is in senior 2, we give her another 17.2 until the child is done with senior 6. But then, God forbid, if Sheila Namagembe passes away before the child gets to senior 1, right? Assuming she passes away, God forbid, when the child is in P1, insurance will keep the child in school. Annually, we'll be giving this child a child income benefit of 15%. What is 15% of 81 millions? It is 12.1. So we'll pay 12.1 to keep the child in school. So we pay P2, 12.1. P3 point until the child finishes P7. When the child is done with P7, yet God forbid, Sheila had already passed away, but the child is in school. When the child gets to senior 1, we'll keep the promise of Sheila. We'll keep the child in Namagunga. We'll send the child in Namagunga and we pay school fees until the child is done with senior 6, until the end that Sheila's dream has come to pass. So either Sheila passes away or Sheila is alive, the child's education is secured. Not only that, we don't only look at death. Even when Sheila becomes critically ill, the child income benefit applies. Even when the child, when Sheila becomes permanently totally disabled, the child's education applies. So the child keeps in school. Either we are alive or dead, the child keeps in school. Hope you've understood that clearly. Thank you so much for your time. Unless you have a question, that is a total education plan. If you find someone who is interested, reach out to your leader, send you a quotation. You know how to calculate. I'm going to still send you this audio after the presentation. Thank you so much for your time. Do I have any question? Brian, have you understood? Put up your hand if you've understood. Sheila, have you understood? Put up your hand. Then I want to ask, many people have disappeared, we've remained 4. I want to find out how many people would buy a total education plan. Wow, thank you so much. I can't wait. So please sell them. That was a total education plan. Thank you so much for your time. See you tomorrow at the same time. Thank you.
Thank you, Madam Brenda. Well done.
You're welcome. Thank you too.